mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in roughly 25 to 30 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. Very excited to be announcing, well, not announcing the winners of the comp, but wrapping up what was a very exciting 6 weeks for us.
Absolutely. We've made it to the end of Australia's next top trader. As you said, 6 weeks ago, we kicked off on the 11th of March, and as did hundreds of other players from around the country, mostly from universities, and some of them were trading for the very first time. So our goal was to, I guess, encourage those that hadn't traded for the first time to dip their toe into the water and at least place a single trade over the 6 week period. And hopefully some of them have done that and been successful at it, Ren. I know that you've certainly been more successful than I have, but we'll come to that a bit later on.
Okay.
So I guess, Ren, today we want to, as you said, wrap up the 6 weeks. As always, we'll do a market update for the last sort of 5 days of trading, or 4 days because of the Easter break. We'll look at what sort of happened over the 6 weeks of trading, some of the stock tips that Matt gave. We'll review our portfolios and have a bit of a chat about some of the lessons that we've learned, and we'll go from there.
Yeah, sounds good. Do you want to start with what happened last week, and then we'll sort of zoom out and talk about the 6 weeks?
Yeah, sure. So S&P 500 and the NASDAQ were both relatively flat. We didn't have trading last night because of the Easter break, and apologies, I did send an email out to all traders saying that last night was the last night of trading, completely forgetting that it was the Easter break. So a bit of a boo-boo there, but anyway, 4 days of trading and markets were pretty flat. Oil bounced a little bit off last week. The Mueller report come out, Ren, so Trump was on fire on Twitter. I'm not sure what impact that really had on markets, though. Do you have anything to add to that?
Oh, no, we'll save it for the politics podcast, but it's a mess out there.
It is. So, do you have any update from last week?
No, I think what you said was basically summed it up. S&P down 0.1%, NASDAQ up 0.2%, Dow Jones Industrial Average up 0.6%. So everyone had a pretty quiet week going into Easter. But in saying that, if we get into the individual companies and sectors, there was some interesting stuff. So should we do that?
Yeah, let's do it.
So I think we'll start with the good and then we'll get into the bad. Semiconductors, they have had a good week, and they've actually been doing pretty well for the past 6 weeks. But last week, the semiconductor index was up 4.1%. So that's an index made up of companies that produce semiconductors. The big driver there was Apple and Qualcomm settled an intellectual property dispute that had been dragging on for a while, and Qualcomm jumped up 39% on the news. So if you had put all your eggs in the Qualcomm basket, you may have won the competition in the last week.
Wow.
Unfortunately, I didn't, so I didn't win the competition. And then also in that semiconductor index, Intel did quite well and jumped about 5%. On news that it was dropping out of the 5G modem business. So semiconductors had a good week. In terms of who had a bad week, healthcare just continues to get pumped.
Yeah.
Last week, we talked about how the sector was down 2.4%. This week, another shocker, down 4.4%. And that was despite some pretty positive earnings results from companies like Johnson & Johnson, United Health, and Abbott Labs. So if we think about why that's the case, there's just so much uncertainty in the US healthcare sector. You know, there's presidential candidates talking about getting rid of private health insurance, talking about Medicare for all and all these big policy proposals. Trump got rid of Obamacare, got rid of the individual mandate, but didn't put anything in its place. So it's just, there's so much uncertainty in the market. And, you know, as an investor, you're trying to...
it's the last thing you want.
Yeah, because I mean your whole investing thesis is based on predicting the future.
Yeah.
And so the more uncertainty you have, the more risk that goes into it, the looser your assumptions have to be, and the bigger range of outcomes that could come about. and you got to price that risk in, and the market's pricing that risk in, and until there's some more certainty, which doesn't look like it's coming anytime soon, healthcare is a tough place to be. But in saying that, potentially there's some value opportunities that will come up if it keeps sliding so much.
Yeah, good point.
Another sort of big headline for the week was that companies started reporting their Q1 earnings results. So if you were investing based on companies that were reporting, you had a lot to choose from. And surprisingly, a lot of companies continue to beat expectations, even though people keep talking about growth slowing and stuff like that. So, some of the companies that you've probably heard of that beat earnings estimates are Union Pacific, Honeywell, Morgan Stanley, Unilever, American Express, Nestle. They all beat expectations, and for some of them, expectations may have been set pretty low, but pretty positive when the number of companies continue to beat expectations.
Yeah, for all this chat that's been going on for a while now about this fear of or expectation of slowing growth and whatnot, I certainly don't see it translating into results. So it's making it difficult to. I guess you've just got to go with what the data's showing, and that's showing that things are pretty good at the moment. It's a difficult situation to invest, I think, when there's such conflicting opinion.
Yeah, definitely. So a couple of bad points for me, 3 quick ones that I reckon are notable, not just for the competition, but also longer term. So number 1, Netflix, they beat revenue expectations, but their shares fell 9%, and that was based on expectations for the future. They've recently increased their prices in the US. Disney's announced their streaming service, and so investors are expecting not as many quarters where they beat expectations going forward. So their share price fell 9%. A company that a lot of people probably haven't heard of, I hadn't really heard of, but I think is notable, Pier 1 Imports, which is a US retailer with close to 1,000 stores, has announced that it will close up to 15% of their stores after losing $70 million in a quarter.
Wow.
You keep hearing about the Amazon effect. You keep hearing about the retail apocalypse. This is another big US retailer that is closing a lot of stores. So it just continues, this trend just continues of physical retailers struggling to compete with their cheaper online competition. And then third bad update, and this one probably hits close to home for you, Bryce. Skechers, your favourite shoe brand, fell 12% after missing both revenue and earnings figures. So I guess you haven't been shoe shopping for a while.
No, Ren, I haven't bought a pair of Skechers for a long time, maybe ever.
No. So their net income went backwards from 75 cents a share this time last year to 71 cents a share. But you know what?
What?
That it is short-term bad news for Skechers, but you zoom out a little bit and they were up 54% year to date before they fell 12%. So
there you go.
As a shareholder, which I know you are,
shoe
you
holder,
can't be
you
too
mean?
upset. Yes, very good. So a lot happening in the US market at the moment. Well, there's always a lot happening, but with quarter one earnings reports this week, next week, and the week after, we'll get a lot of interesting stuff coming out. A good opportunity to test your thesis, to see some long-term trends emerging. And next week, approximately a third of the S&P 500 companies will be reporting. So there'll be a lot of news out.
Whoa.
And one that I'm going to be paying particular close attention to, Boeing report on the 24th of April.
Yeah.
So that'll be very interesting to see what's happened there.
Yeah. Nice, Ren. Great wrap. A third of the S&P 500 reporting next week.
Yeah.
Wow. It's a lot to contend with. The ever evolving and constantly rolling reporting cycle of the US, it always provides a lot of entertainment.
So much. But the important thing is we can't get too bogged down in the quarter by quarter stuff. Well, I mean, we can, and people make a lot of money doing it. But for me, it's all about confirming longer term trends rather than how much money did they make this week, next week,
Absolutely. Nice, Ren. So let's take a step back and zoom out a bit and have a look at what the markets were doing over the total 6 weeks of competition. So we have the S&P 500 was up 4.37% and the NASDAQ 100 was up 7.34%. So some pretty decent gains there. If you parked your money in an ETF that follows both indexes or an ETF that was leveraged on both indexes, you would have certainly done reasonably well without having to worry too much about individual stock picking. There was a lot that went on during that period, but I don't think there's a need to go into the detail because we did that sort of over the last 6 weeks.
I think one thing for comparison's sake, it's if people want to know how that performance is in context, the ASX 200, so the Australian market, was only up 1.3% in that time. So the US market significantly outperformed Australia.
Interesting stat. That's yeah, wow. So that just goes to show the size of the US and the amount of money that's going through it. It's just so much bigger than the Australian stock market. So many more companies to invest in from a global perspective and a lot of money pouring in. And that's one of the reasons I think why we both like the US. There's a lot more happening and a lot more going on. Not to say there's anything wrong with the ASX, but yeah, over 6 weeks, it's only up 1 point whatever percent it was. So if you'd parked your money there, you'd be flat.
Yeah.
Nice. So do you have anything to add from a total perspective, Ren?
So I think one thing that we touched on every now and then in the 6 weeks was oil, and it had a great 6 weeks, but it's probably worth just, now that we've had the 6 weeks, how much it has performed well. So West Texas Intermediate, which is one of the main forms of oil that's traded, was up 12.8% in the 6 weeks, and Brent crude, which is another of the main forms of oil that's traded, was up 7.6% in the 6 weeks. So if you had invested in oil, you would have actually outperformed the US market. So not good if you're trying to fill up your car at the petrol station, but pretty good if you're
filling your bank account.
Yeah, or if you're, Saudi Arabia or the US shale industry or Russia or, any of those big oil producing countries.
And one of the big stocks that we talk about in terms of oil is OILU, OILU. It's a 3 times leveraged index on stake. So it has done very well over the last 6 weeks, or even since the start of the year, really would have made a decent return. Okay, Ren, so I want to just touch on a couple of stocks very quickly that we have spoken about. And that's Matt from Stake, expert trader, has sort of given us advice or tips on, not a buy, hold or sell recommendation at all, but just sort of these were on his watch list. And this is from the expert's mouth. So the first one was the innovative industrial properties, exposure to weed and the cannabis industry. And over the last 6 weeks, it was up 10%. So if you'd parked your money in there, would have done reasonably well. However, CanTrust, which was another weed-related stock that IPO'd just before the competition, was down 20%. So if you'd had your money in that, hopefully you had a stock loss. He then had the Danaher Corp. It was up 0.35%. Alta Salon up 13%. Tandem Diabetes Care was one that he recommended. It was down 21%. So overall, if you'd had your money in all of them, you'd be reasonably flat. Just goes to show that you don't need to pick all winners. Some of them have done reasonably well, others not so. But if you'd covered your bases and gone both, you would have come out reasonably flat. So yeah, we spoke about those.
There you go. Were you in any of them?
I was in innovative industrial properties that was up 10% overall. However, it's important to note that 10% had some significant slides in it as well, and I had a stop loss on it, so I got stopped out maybe 3 weeks ago. Lesson learned, I guess, is to make sure your stop loss limits are taken into consideration so that you don't get stopped too early, which we always talk about. And that was it. I didn't get in any of the others.
Fair enough.
One more stock, Ren, I want to talk about, which we spoke about maybe 2 weeks ago, was Lyft. So Lyft IPO'd. It's the ride-sharing company, competitor with Uber. And we all know, Ren, that you were desperate to get in on the act and thought it was going to be your winning move. Luckily, you didn't, because since it's IPO'd, it's now down 25%. So things not going too well for Lyft, and I'm really looking forward to doing an episode on Uber, Ren, because the more I read about the way that they're trying to structure this IPO and the incentives that they're giving to the CEO and all their drivers, it sounds like they're trying to inflate the value of the company for sort of external reasons, exit, I guess, reasons. Really keen to hear your thoughts, but I think we should dedicate another episode to that.
Yeah, 100%. We'll save most of it for the next episode, but it's come out that the new CEO, he gets a $100 million bonus.
100 million, yeah.
100 million if the company is valued at 120 billion when it goes public. So,
but the kicker with that is it has to maintain that valuation for 90 days.
Yeah, that's tough.
That's so tough. And the other thing that I want to discuss is they're giving $420 million in cash bonuses next week to drivers around the world, with the hope that they then use the money to buy into the IPO and drive and drive demand that way. So like it just seems like there's this desire to hit this valuation, I guess, because everyone who's invested wants to get their return now. It's been a while since they started, and they're still losing money, but sounds like there's this hidden desire, underlying current of let's just make as much money as we can, obviously. But anyway, let's save that for later.
Yeah, 100%. And while you're talking about tech IPOs, Pinterest went public this week. I think it was valued at like $10 billion.
What?
And the shares jumped 25% or something on the opening day. Now, I don't use Pinterest. Obviously, there's a lot of value there, but I've got to say I was surprised it was valued at $10 billion.
$10 billion? That's ridiculous. Unbelievable.
Yeah. So there's a lot of chat these days about tech IPOs, and some have done quite well, but there's a lot that haven't done well. And there's talk about where the value is coming from at the IPO, and they seem to all jump very quickly when they first go public and then have a slow descent afterwards.
Yeah, fizzle.
So maybe we'll talk about that in a tech IPO episode and how to think about investing in them and what to watch out for. But it is an interesting time to be watching this space, and I'm sure there are some people who look back at the early 2000s and look at some of those IPOs and see echoes, shall we say.
Yeah. Okay, I was going to talk about Bill Ackman as well, but we'll leave that. It's another interesting story that's come out over the last sort of 3 months. But let's jump into some lessons, Ren, and then we'll wrap it up. Maybe we'll go a couple of lessons each, if you have any, from the last 6 weeks.
We're going to have to talk about where we finished up in the competition. I know you're trying to avoid that.
I was hoping you didn't. Realise.
We'll do lessons, and then we'll finish on that note.
Okay.
So, big lesson for me is, and I've probably said this before, but I'm not good at short-term trading. I've learned that about myself, and I think when things do come off, it is luck more than skill. So I have a lot of respect for people who can systematize the short-term stuff and really, perform. But in saying that, the biggest thing for me is because it's more luck than skill and I'm not great at it, having a stop loss in there was critical for me to just limit the extent of my mistakes.
Yeah, good point. And did you feel that you did reasonably well at figuring out what size stop loss to put on?
No.
That's the next step.
Yeah. Again, it was sort of, how volatile is it? 5%, 10%. But there wasn't a lot of science behind it. And I think if this was something that I wanted to pursue, I would be jumping into a lot of books and really trying to get a good understanding of how some of the experts do it. But for me, I am pretty happy being patient and investing with a longer term horizon, and trying to find companies that I think will grow. That just makes sense to me. Trying to figure out trading volume and charts and all that just isn't as intuitive to me. So
yeah,
I'm just going to stay in my lane and do what makes sense for me.
Yeah, nice one. Okay, so one of mine, I think, Ren, this is one we always talk about, and generally speaking, is to forget the stock pickings. Last time we did a short-term trading competition like this, absolutely bombed because, as you said, we were relying primarily on the luck side of things more than the intellectual thinking side of things. And my approach this year was to try and remain, as you said, in our lane and pick stocks that were a bit more in line with our investing strategy. And what I mean by that is I think you and I are both reasonably good at understanding the broader macro environment and economic trends and dialing in on industries and whatnot. And in a shorter period of time, and there are a number of stocks available that let you take advantage of these trends, and particularly with some leveraged products, and you can make some decent returns. So my lesson was to at least find stocks that allowed me to play to my strengths, and that would be, oil, for example, was a good one. The NASDAQ, we both recognized that these were trending, and vice versa. If they were, going on a downward trend, then there's stocks available there for you to take advantage of that. But yeah, first lesson I think was that.
There you go. Any other lessons from you?
One that you often talk about, and that is to copy others. And there's nothing wrong with in the investing world, trying to be original or trying to be the outlier. If things are going well for someone and they're an expert and whatnot, then if you don't, in such a short period of time, without having the knowledge and skill, copying someone else is certainly a strategy you could follow. And as we saw, the stock tips that our expert Matt had given, there were some absolute winners in there. So I think a lesson there is certainly take advantage of those sorts of opportunities when they come and back them in just as much as you back yourself in.
Yeah, nice one. So in summing this up, before we say where we came out, I want to set the range. So the highest performer got about 36% improvement in the 6 weeks.
Yeah.
And then the lowest performer managed to lose 94% of their money. So
really?
Look, yeah. If that person's out there,
shivers.
Reach out to us, and I'd love to just hear what your strategy was and how you managed to lose 94%, because I reckon that's difficult to do, to lose that much in 6 weeks.
Yeah, that's hard. Well, we'll try and reach out to them. We'll have their details. So
yeah.
Get in touch.
Look, if you don't want to talk about it, I understand, but it would be interesting to know. So anyway, so that's the range from negative 94% to plus 36%. We didn't get nearly that high or that low. You ended up 369th placed, losing 2.3% of your money.
Okay.
And then I ended up 106th, so almost cracked the top 100, up 1.97%. So
wow, so you were 1% and you didn't make the top 100, and number one was 36%. So wow, some significant gains for our top 100.
Yeah. So look,
nice.
I came into this competition wanting to beat you, and I did that, so I'll be happy with that. But I think what we learned is that there are people far better at this than we are. And so hopefully they continue to listen, but understand if they don't feel the need to.
But also really interested to know what their longer term approach is as well, because we've made it very clear that this isn't our style of investing, Ren, and I'm sure the guys that have come out on top, maybe they have a different approach. So we will definitely try and get in contact with our top 10, just also to validate that they are uni students and whatnot, but we'll really try and extract some of the strategy that they had over the last 6 weeks and get it all compiled together and share it with everyone in due course. So we will be announcing the winner once we do finalize all the results and figures in the coming week. And we'll also be re-announcing it at our party on the 4th of May in Sydney. So come along to that if you can. If you're in Sydney, we have a location now. We'll be revealing that on our socials this week as well. It's because it's coming up very quickly, Ren.
It really is. We better start getting set times and run sheet.
What, are you doing, playing a song or something?
Yeah.
DJ.
Yeah.
quickly then back on to portfolio. What was your star performing stock?
So it was Dell, and that was a classic example of luck more than skill. But I bought it, I think, week 2 or 3 of the competition, and I put a stop loss in. I bought it with a couple of other tech companies, and they got stopped out, but Dell just kept slowly ticking up. So not one that I expected at all, but it did all right for me. What about you?
Mine was the Ultra Pro QQQ. It's a 3 times leveraged NASDAQ 100. Bought that on day one. It's up 18%. So that was an absolute screamer for me. However, as you know, I'm down 2%, and that's because of my specky pick, Sibanye Gold Limited, a South African gold company, down 18% as well. And I had a few other little losses in there. So
there you go.
Should have stuck to my guns.
Yeah, should have. All right. Well, I think it was a good competition. We both learnt a lot, and hopefully we got some people interested in investing and maybe even interested in this podcast. If you just joined us for the competition, hopefully you stick around. We'll keep doing, Basics 101. We'll keep doing deep dives into different industries and looking at different markets. So if we've piqued your interest in investing, hopefully we can sustain it now up beyond the competition.
Yeah, that's a big win for us. We wanted to encourage as many people to get into the markets as they can, because as we've always said, Ren, there is no better lesson than to be in it and learn the ropes as you go. You can always do paper trading or read as many books, but it's not until you're in there that you really understand how you're going to react to the market, and you just start going down rabbit holes, which is the best way to do it, in my opinion. So yeah, nice, friend. It's been fun. Hopefully it's not the first and last time that we do Australia's Next Top Trader. There's been some interest from non-university students and other members of the community to play and have a crack at winning first prize to New York City and the New York Stock Exchange. So we'll endeavour to hopefully do it again at some stage in the future.
Yeah, 100%.
All right. Well, it's been fun, Ren. Congratulations. You beat me. I'm going to go have a sulk now. No. But if there's anything else you want to add, let us know. Otherwise, we'll chat next week.
No, let's chat. Later this week.
Yeah, true. Yeah. Later this week, because we are doing our new format from now on, back to old school equity mates, as you said, twice a week, Mondays and Thursdays. So we'll chat on Thursday.
Sounds good.
Okay, so we have come to the end of Australia's Next Top Trader. As you would have heard, Ren and I gave a bit of a market update and a bit of a wrap of how our portfolio has performed and how we have seen the market play out over the last 6 weeks. But for the last time, for the competition, we're joined by Matt Leibowitz, CEO and expert trader at Stake. Thanks for coming on and joining us on this episode, Matt.
G'day, Bryce. Thanks for having me.
So we haven't checked in with you for a couple of weeks. We thought we'd leave it and do a bit of a summation at the end of the competition. We started off with your views on the market right back in March 11 was when we kicked off, and you mentioned that, we were obviously in a bit of a bull run since the end of December, but you were not necessarily concerned, but a bit nervous about how the market might play out over the next 6 weeks. But you also had a strong view on marijuana and weed, and it was in a bit of a bull run as well. So before we jump into the nitty gritty, let's just start with a broader view on the market. I'm wondering if your view has changed much over the 6 weeks of trading that we've had.
I think the market's up sort of 7% over the 6 weeks, which is a really strong, performance. I mean, markets generally move on average around 7% up a year if you sort of look at the last sort of 50 years. So that's a great result for the market in a 6-week period. So, I'm still feeling like it's toppy, but at the same time, it keeps proving me wrong. So I'd rather be long than short right now.
Yeah, we were talking about that. It's a really confusing time at the moment. You've got a lot of analysts talking about, that they think growth, coming in the next sort of year is going to be somewhat subdued. Companies aren't going to be reporting and beating expectations like they have been over the last few years. But the reporting seasons that we've seen over the last sort of quarter and the wrap up of 2018, they're certainly exceeding market expectations. So it's creating a bit of environment that is somewhat confusing to invest in. So I'm wondering what your sort of strategy is over the next, say, let's say if we're going to do this again for 6 weeks, would you be, I guess, the same sort of strategy?
Yeah, no, I mean, the way I look at it is really clear. You only respond when you've got confirmation that it's actually turned against you. So you don't get out of a trade until you've been proven incorrect. Right now, if you're making money on the long side, stay on the long side until you're not.
So
I think that there's a great saying. It's stick with a trend until it bends at the end.
Nice.
So it hasn't bent yet.
So speaking of long, you recommended, well, not recommended, but we discussed QQQ or TQQQ, I think it was, right at the start of the competition, a stock that is 3 times leveraged the returns of the NASDAQ 100. And it is up just under 20% since the start of the competition. So that's a stock that has certainly benefited those that took the long mindset. And I think one of our traders in the top 3, he was long TQQQ. So a very successful trade for him. Briefly, you were very bullish on the weed sector, cannabis sector, at the start of the competition. Has much changed in that space? To be honest, I haven't really followed it. Just interested to know if much has changed.
Not materially. I think we had a couple of bad reports for some newly listed stocks. CanTrust was one.
Yeah.
I wouldn't say I was overly bullish, but I think it was a very hot space with a lot of activity. And there's a little bit of maturity in the space where you see some stocks going up and down. Double IPR was my choice.
Yeah, up 10%.
And that's up 10%. But there are other stocks in that space that fell significantly more. So I wouldn't get overly excited about the weed space, but I think it's really an individual stock basis. The whole space is still interesting, and there's still a lot to unfold in the weed space. So it's just a sort of watch and see sort of approach with those names.
So Ren and I reviewed some of the stock picks that we spoke about over the last 6 weeks. So we won't go into too much detail about those, but as you said, IIPR was up 10%, and another good one of yours was Alta Salon, up 13%, the one that you were walking past every day while you're in Chicago. So
it's the ones I got wrong, right?
Still going strong. But something that we touched on this morning is the IPO space. And as we discussed, I think a couple of weeks ago, there was some really big IPOs coming, and we were fortunate enough to have one of them during the competition, which was Lyft, now available on Stake. And since then, we've had a couple of others. So I'd really like to get your opinion on your strategy when it comes to IPOs. Obviously, there's a lot of hype around them, particularly Lyft. We've got Uber coming. CanTrust was another one that happened just before we started the competition. And then there's Pinterest and Zoom as well. What's your sort of strategy when it comes to these sorts of things? For example, Lyft, huge amount of hype, but it's now down 25%. So you'd be pretty disappointed if you got into that.
Yeah, IPOs are really interesting. And I think Australians, majority Australian audience we're speaking to, there's a real affinity towards IPOs in Australia, purely because a lot of people got into the market for the first time with IPOs, when Telstra was, it was Telecom Australia way back and became Telstra IPO'd, Commonwealth Bank IPO'd, and every Australian got access to these names. And, you can probably ask your parents who bought, got into those IPOs, how much money they've made on those.
Yeah.
And so people get very excited about IPOs because you're getting something essentially that no one else. It's quite exclusive in a way when you actually access an IPO and then it lists on the market. My strategy, which will be different to everyone else's, some people have got great access to their broker or to an investment bank that's doing a listing, and they can get access to IPOs. If you don't have that, which a lot of people don't, 99% of people don't, is to really just, for mine's a wait and see approach. I want to see a lot more transparency. I want to see how the stock's trading. I want to give it some time because it just gives me the feedback of actually how this thing's going to respond. You can look at the numbers in a listing document, but it doesn't tell you how the market's going to respond to it.
Yeah, it's an interesting one. I like the word transparency there. I was speaking with Ren, and I think, and you just before we started, with the way that Uber are going about their IPO, and it seems to me, obviously, they are just trying to value the company as high as they possibly can, so that early investors who have been pouring money into it over the last few years, I guess they just want to get an exit, get their money back and run for the hills. I don't know if that's what they necessarily want to do, but there's incentives for the CEO to get $100 million if he can get a valuation of $120 billion, and it stays like that for 90 days. And I'm reading in the paper that Uber next week are going to be giving out $420 million in cash bonuses to their top performing drivers in the hope that they will then use that money to invest in the IPO and drive up demand for the stock that way. So it's a really interesting one in terms of understanding where the motives of the company. And if you don't really know, you could get seriously burnt going into an early stage IPO. Do you have thoughts on the Uber?
My first thought is you're incredibly cynical. That's not bad. There is some level of transparency. Before a stock lists, what happens is there's what's called a book build.
Okay.
So the lead investors, investment banks, so, the big banks you can think of, Goldman Sachs, JP Morgan, Citibank, for example, Morgan Stanley in America, will go around and they'll speak to asset managers, institutions, brokers, and they'll try price the thing. So they generally give a approximate value. So, for example, Pinterest was looking at $20. I think we got it away at 17 or something. I may have got that wrong with Zoom, but so what happens is there is some level of bidding before. But obviously, if you're an investor who's been in a name like Uber, for example, for 4 to 5 years, and you've been in the private market, there's only been a few ways to get out, i.e., someone comes in and offers to buy it off market, which is a complex process. But the best way to get a liquidity event is for someone to buy out the whole company. And in a case of Uber, the size of it makes that nearly impossible.
Yeah.
Or it's to take the thing public and finally get some cash out of the business, especially when the thing is loss-making. You're either going to be having to continue to put money into the business to support its ongoing, being an ongoing business. So that you're going to have to dip your hand into your pockets again. So a lot of the investors are probably really looking forward to getting out into the market so they can actually get out of the stock. So the only option for something like an Uber is to list, and obviously they want to get their shareholders the best price. That's what they're looking to do. So therefore you have to have some level of, you have to be cynical about it to some extent. But all those other things, these are pretty well regulated markets. I don't think people can sort of behave like that, or I hope they wouldn't.
Yeah. It's interesting, from what I've been reading, the direction I guess they're giving to their CEO in terms of compensation for the float is, as I said, $100 million, but it's also $100 million if he does find a buyer just to buy out the whole company. But it'd be hard to imagine who that would necessarily be. As you said, $120 billion. It's a lot of money to outlay on a loss-making company at this stage. Yeah, we're almost there. So let's talk a couple of others. So Pinterest, it's IPO'd. I think Ren said 10 billion or something.
No, Pinterest was up significantly on the first day. It's up just 28.5% after listing. So that was a great result for those that were in before it actually went public.
Yeah. And where is it now?
It's got an interesting story to it. It hasn't really grown really, really fast. It's been, Pinterest has been around for a while, and it seems to obviously be something that investors want to support. It's a popular name. I don't really know much about the company behind the scenes, but obviously if you're up 28.5% on your first day, you're going to be pretty happy being a shareholder of that.
Yeah, absolutely. So Zoom as well, It
listed on the same day as Pinterest.
Okay, interesting.
As well. So under the code ZM, Zoom Video Communications. It's actually an interesting story. There was another stock called Zoom, and it was up 1,000%, but it was a penny stock.
Oh, wow. So there could have been some excited investors.
A shareholder in the penny stock Zoom.
Imagine if you accidentally bought that one.
Those people reached the wrong stock code.
That would be awesome.
There's ZM and there's Zoom. So sometimes it pays to be second.
Yeah, absolutely. Wow.
Yeah, Zoom was up $26, which is 72% from its listing price, which is phenomenal.
Whoa. On the first day or?
On day one.
Whoa.
Now, Zoom's profitable. And a lot of the IPOs you've been seeing in the last, year, been incredibly unprofitable businesses.
Yeah. Big tech companies.
So I think the return on unprofitable companies has been higher than profitable companies. That's because people are obviously paying for growth. But I think there's been a shift recently. And the fact that you're seeing a lot of unprofitable businesses list gives me a sense. That also makes me a little bit nervous about the height of the market. People are looking for it as an opportunity to cash out while the market is hot, per se, and then leave the stock in the hands of people that don't really know the full story behind the business. That's a cynical way to look at it, but
no, I totally agree with that. That mindset that it's sort of like the tech boom. Everyone was cashing in while people were ready to sort of splash some cash, and unfortunately, it all came crashing down. So
the numbers are very similar in terms of the number of companies listing between around 99 and 2018, 2019. So they haven't seen this sort of activity in the listed market since 20 years ago. So
wow.
I don't know if it's history repeating, but it's just something to be aware of.
Yeah. So I take it then, have you got in on any of these, or are you still just sitting back to see what happens? Is this not really your domain at the moment?
No, not my domain. There's people that are a lot better that can. I can't really read balance sheets and get a good sense. The way I like to invest is based on what people are actually doing, what they're buying and selling.
Yeah, so you want a bit more history.
Asking someone with my attention span to read a financial statement and deep dive into a company is probably not a good. It's not my personality. At the end of the day, you need to invest and trade according to that personality. So there are some people that love this stuff and are really good at it, and they should keep doing it. There are some people that aren't like me, and they shouldn't do it. Simple as that.
So I guess from a lesson perspective, Ren and I were talking this morning, there's a few things that we learnt from this competition and carrying off the competition that we participated in when Stake did their rebrand, and we played a game for a couple of weeks. Combined with this one, we feel like we're certainly learning a lot more about how to control our trades in a 6-week period or a shorter period of time. It's something that, as you know, it's not our preferred style of investing, I guess. We're much more longer term focused, but I've certainly really enjoyed the aspect of looking for stocks with momentum and that investors are really, I guess, getting behind, looking at averages and that sort of stuff. And it's been a good learning experience for us. For those investors that have just started, though, and dipped their toe into the water, and they may have lost a bit of money, some, I hope, have done reasonably well. Do you have any sort of lessons on what they could do from here? Like comp's over, I guess a bit of the momentum could die. What would be sort of some tips from you to keep them enthused and going?
Just stick at it. The market it moves every single. You don't need to be in a competition to enjoy and the challenge of the share market. You wake up again, the US market's open on Monday while Australia's closed for a public holiday. So, on Monday night, the US market reopens and it's game on again. You've got skin in the game. The competition is just a small window into your total investing life. And you need to look at this holistically. It's just it's so awesome. You wake up every day or you stay up late and you see what the world's doing, and you're in that coliseum. So It doesn't matter if you're. I mean, for me, it's about being engaged with the market. So the 6-week competition is really good to see what are things that move over a short period of time. How do things respond? What are the trends in the market? It's just a little snapshot. It really should just be the first step in your entire investment journey. And being able to come back in on Monday, you're still in a competition. You just may not be on a leaderboard, but you are competing against yourself every single day, and that's how they need to look at it. And,
you raise a good point. 6 weeks, I don't want to discourage anyone if they didn't do so well in 6-week period, because as you always say, you've got to find the style that works best for you, and that might take a few years to even figure out what that is. So if
ongoing process, I wouldn't even call it years; it's a lifetime journey.
Yeah. So I mean, if you feel like it wasn't your jam or your thing over a 6-week period, then as Matt said, certainly stick to it, because it's all about just starting, and I hope that's what we've achieved. And I'm sure you agree, Matt.
No, totally. I think, this whole experience is really just to get you into the market.
Yeah, absolutely.
Someone is going to win it, and that they may be the best investor of all time. The likelihood is they're always going to be learning. A lot of things need to go your way in 6 weeks for you to win.
Yeah, I think we may have found the next Warren Buffett. Who knows?
Absolutely. That's why we found the next 10 of them.
True. So, Matt, we'd love to announce who the winner is because they've done incredibly well over a 6-week period. I'm very jealous of the returns that they've made. And, well, to be honest, the top 10 and 20 have done extraordinarily well for the time period. And we'll dive a bit deeper into that later this week. So we'll finalise up the numbers with Stake and then we'll jump back on later this week, Matt, and actually do the big reveal, see who we're sending to New York and the New York Stock Exchange, and also have a bit of a review on what were some of the trades that our leaders made and what were some of the stocks that they were buying into.
I think you're going to have to get them on.
Absolutely. We'll endeavour to get in touch with them over the next couple of days. And then later this week, we should hopefully be able to have a bit of a round table with them all.
It's awesome. There's going to be a lot of great lessons there. It's just exciting to see so many people do so well, and even people that didn't, just being in the market and learning how things work. You can't beat that.
Yeah, absolutely. So I'd just like to say a massive thank you to you and Stake for supporting this competition and obviously providing us with the awesome prize. And we will endeavour to get the other guys on the show so that we can sit down and pick their brains. But yeah, a massive thank you. We couldn't obviously have done it without you. And I'm sure, as we've said, that this will hopefully not be the last time that we can do something like this. So thanks for your time over the last 6 weeks as well. And I know that a lot of our listeners have really appreciated your advice and your stock picks, be them good or bad. They were definitely a really good insight into the way that you think and look at the market. So much appreciated.
Oh no, absolutely, we absolutely loved it. And for us, this is why we're here, really, to get people into the market and being able to share the energy of what it is. And it's, as I said, hopefully for a lot of people, it's the first of a great journey for them. And if we can be part of that, then we're really proud of that. So thanks for your support as well. We really appreciate it as well.
No, all good. So if you are just tuning into the show and you're interested to know what we're talking about, you can sign up to Stake and start trading the US markets at any stage. $0 brokerage. Head to stake.com.au and you can sign up and get trading. So Matt, we'll check in later this week. So thanks for coming on.
Thanks for having me, Bryce. Good on you.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.